I'm Roger Herring. I am the founder and CEO of Investors Accounting LLC and the founder and CEO of Precision Planning Group. I want to welcome you to this on-demand webinar, which is part of our series, The Wealthy Playbook. Today's lesson is how high earners can legally pay little or absolutely no tax. That's right. I want to welcome you today, and let's get going. An alternative name for today's webinar is how to turn $500,000 tax liability into $50,000 or less. Now, Roger, you got to be full of it. It's like, no, actually, I have turned $500,000 tax liabilities into zero. It depends on the situation. It depends on the client's risk tolerance. We'll talk about all that in a little bit. So here's a disclaimer before we even get going. The information provided in the seminar is for educational purposes only. It does not constitute legal, tax, or financial advice, and no offer or solicitation for the sale of securities or other financial products is being made. Unless you're already a client of this firm, no client relationship is created by your attendance or participation today. If you are an existing client, please do not act on any information discussed today without consulting with me directly to ensure it aligns with your personal circumstances and objectives. In other words, don't do anything I say. A little bit about me. I've got 35 years of doing this, and this is 24 years I've been in full-time practice. This is my 25th year. Before this, I have been a staff accountant, a controller, and a CFO. And how did I come to be self-employed? We got bought, and you know what happens when you get bought. I am an accredited investor. We'll talk a little bit about that at the end of the presentation today. And I was one of the first in the nation to get the MSCTA designation. That is a tax strategy designation, and that is bestowed by Mr. Mark Kohler, JD, CPA. If you don't know who he is, just go to YouTube and look him up. He is one of the top tax and legal mentors in the country. So, I am also a published author. I have numerous ebooks out there, but the first place I was ever published was in the Congressional Record back in 2009. I had written a white paper about an issue that was going through Congress where the S Corp was in danger of being eliminated. My white paper was sent to a congressman by one of my clients, and one day I am doing a search for my name on Google, which lots of us will do sometimes, and lo and behold, there's my white paper that had been read into the Congressional Record. Nice place to be published. So let me tell you a little bit about us. I founded this thing back in 1999. It was just a side hustle to be able to write some stuff off. And when the company I was working for got bought, I went into full-time practice in March of 2002. In 2005, we started specializing in real estate clients, and those are everything from me, myself, and my computer, and I want to fire my boss, to multi-million-dollar deals. In 2016, the practice became fully real estate focused, and we started serving all size real estate clients. Then in 21, we were requested to expand scope and include highly compensated professionals in high net worth planning, which we did. So here's how that took place. We began taking those clients, and we recognized that there really was a gap between planning and execution. In 23, I had a client that sold a business and had a $3 million capital gain, and we had limited solutions available to them to do anything with. So in 2024, I went back to school and earned that MSCTA certification. And the clients immediately started saving money. Then in late 24, I went back to school again and I learned a plethora of advanced strategies that can really serve complex situations and high income clients. This year, we launched Precision Planning Group, which is really the next step in the company's evolution. We do tax planning for sophisticated clients. We have high-end strategies, some of which you're going to see today. So, what's the difference between tax prep and tax planning? I mean, I had a gentleman that was making over $1 million a year, and I showed him how I could immediately save him $75,000. And when I told him how much it would cost, his quote to me was, "I've never paid more than $800 for an income tax return." And I tried to explain to him, you're not paying for the income tax return. You're paying for me to help you implement the strategy that's going to save you the $75,000. So let's just talk about the difference here. Okay, tax prep looks backward. Basically, it's scorekeeping. It's the guy reporting what already happened. Square pegs, square holes. You're, we file a return. It's accurate, but the decisions have already been made on it. There's nothing we can do to affect tax, or there's very little we can do to affect tax at the time of filing. And yes, you're going to pay for a tax return based on the time required to complete it. Whereas tax planning is proactive strategy. It looks forward. It shapes your decision. We anticipate events and the opportunities and the pitfalls. We put in place proper structures and strategies before the end of the year when we can actually do some stuff. It directly affects and improves your results. Now, it's priced based on the results, the value. Well, Roger, I didn't think an accountant could take a contingent fee, and it's not a contingent fee. Contingent fee means that an accountant is based on a percentage of the refund. That's not what we're trying to do. We are not trying to create a refund. What we are trying to do is to have an overall lowering of your income taxes through effective strategy. So, in a nutshell, tax prep tells you the score. Tax planning changes the game. Now, I'm going to tell you, there's only 3 reasons, guys, that you pay tax. Reason 1, you made money. Reason 2, you did something dumb. Okay? You failed to plan. You sold, you didn't have a strategy, you left money on the table. Reason 3, you did both. And yeah, like it says, the IRS thanks you for your generosity. So only number 1 is unavoidable. Only number 1 is unavoidable. Reason 2 and reason 3, we're here to make those reasons go away. So, how do you not pay tax? I used to say don't make any money. Here's the reality. Don't look like you made any money. So, how do we make you look like you don't have any money or haven't made any money? We eliminate income on paper. And you know what, guys? We've got strategies that go across the gamut. You might be a highly paid professional, attorney or a physician, executives. You may have a bonus or a one-time income event that really pushes the envelope on your tax rate. Could be business owners that are exiting or have really, really good years. Real estate investors, we work with these guys all the time, or anyone with large capital gains like stock, crypto, real property, a business exit, any of those things. We're going to show you exactly how you can eliminate. We have over 200 legal strategies to draw from. Today, we're only going to show you a few. Are you ready to get into it? Let's go. So, let's talk about risk. There are 5 levels of risk. We don't touch level 5, highly aggressive. We work from no risk to aggressive, and all of these are tailored for the client's level of risk tolerance. Yesterday, I did a tax strategy for a client that said no higher than level 2. We saved them 100 grand just using level 2. It works. Let's have some fun. We got 3 major strategy categories that we play with. First, capital gain mitigation. Now, let me tell you, the best time to eliminate a capital gain is before you do the sale. Okay? The second thing is income mitigation above the line. This is where we're going after your adjusted gross income. And then there's income mitigation below the line. This is where we're attacking your taxable income with credits, deductions, charitable vehicles, and so forth. Okay? Let's talk about a few. Here's some common beliefs on capital gains. I'll just do a 1031 exchange. Well, guess what, guys? They can fail. Or maybe the asset is not 1031 eligible. See, 1031 is only for income producing real estate. So your stocks, your cryptos, second homes, business sales, they don't qualify. Okay? And you got to remember, when you defer something, that doesn't eliminate it. So you got to have a full strategy on the back end for what you're doing. Or I hear, well, I'll just put the gain in an opportunity zone. Well, opportunity zones are great because you just have to put the capital gain portion in it. You can keep the basis. Here's the problem. The original op zones are going to expire in December. So you can't use an op zone this year and have any benefit out of it. Now, new op zones kick in 2027, but they have totally different rules. So the op zone may not be the optimum place. Notice down below, hard deadlines, critical limitations. I use these things all the time, but you got to use the right tool for the right job. Now, let me show you 2 other ways that you can attack capital gains. The first is called a charitable remainder trust. And these things, what they're going to do is provide you with a lifetime income and a charitable contribution in the year that you put the money in. So you get a deduction for your contribution. Now, there can't be any debt, so encumbered real estate is a problem. All right, but if there's no mortgage, it's great for highly appreciated real estate, stocks, or business interests. So here's what you're going to do. Let's say I have $1 million in crypto with $500,000 capital gains in. So I take that crypto and I am going to donate it to the charitable remainder trust. I'm going to get a write-off, not necessarily for the full value because it's going to depend. There's rules around this, and they're way beyond the scope of what we're talking about today. But I'm going to get a significant write-off, and in some versions of the trust, there are several, I can keep managing the crypto and creating my lifetime income with crypto, or I can buy an income producing asset, such as maybe an annuity, but I have an income stream for life. Okay? At the end of my lifetime, what happens? Well, depending on the type of the trust, usually what happens is I have chosen a charity that is going to get the hard asset that's still in the trust. What about the kids, Roger? Well, there's another type of trust called an income replacement trust that we can provide for them. Now, there's something else. It's called a deferred sales trust, a DST. Now, Roger, I thought a DST was Delaware Statutory Trust. Guess what? There's 2 types of DST. Today, we're talking about the deferred sales trust. So what this does is it turns my sale into a installment sale. So here's what's going to happen. I'm going to create the DST and I'm going to sell whatever my asset is to the DST. The DST is going to sell it immediately. So they have got instant cash. Their deal with me is a 20-year installment note. Okay? So I'm going to get paid off over 20 years, and I'm also entitled to the income coming off where that money is invested. Okay, it is a great backup for a 1031, which can fail. Now here's the thing: 1 million in gain and 1 million in proceeds. Well, Roger, I don't have that much going in. Is there a smaller version? Yeah, there is. There's a smaller version of this too. Now, we've eliminated some capital gains. Now we want to attack above the line. We're going to go after your adjusted gross income. And I'm going to show you a aggressive strategy and a low risk strategy, an L4 versus an L2. L2 is, if you remember, is administrative risk. You did something wrong. L4, that is an aggressive strategy. So let's talk about the leverage business opportunity. This is a structured program that's going to generate bonus depreciation up front. And the reason it's leveraged is you're going to put a down payment and you're signing a note. So if you put in $100,000, and this is a 4X LBO, that means you're going to put in $100,000. You're going to take a $300,000 note, and your write-off's going to be $400,000. That's a 4-to-1. Okay? Direct oil and gas, one of the last remaining congressionally sanctioned shelters. And we can take 80% of the intangible drilling costs of oil and gas up front. So let's talk a little bit more about it. First, the LBO. Now, I've got probably 20 different LBO programs that range in their leverage from 2-to-1 up to 20-to-1. Okay, now the 20-to-1 is only for very specific circumstances and for people that own a business normally. But generally, I use 5X and 10X programs all the time. And these go from the gamut: software licenses to foreign currency to films to equipment. Okay, I'm going to get 100% bonus depreciation up front. I've got a return on investment in the back, and I'm getting a monthly cash flow on here. This is designed for people that either have a high income year or they've got a large liquidity event. So let's just take a look at the wheel of life for an LBO. You've got the liquidity event, a business sale, large income, whatever. So remember, you don't have to go out and figure this out. These are established programs. So let's just assume that this is a 6-to-1 program. If it's a 6-to-1, I'm going to set up an LLC and I'm going to buy an asset. I'm going to buy that asset by putting $100,000 down and financing $500,000. Do I have to sign a personal guarantee? Yes, you do, because that's what makes it deductible and gives it economic substance, is the IRS term. Now, we're going to place this asset into service once again through the program. It's in service, and I'm going to take a $600,000 bonus depreciation write-off. I am going to collect a monthly payment every month, and I am going to pay my note, and I have positive cash flow. On the back end, the asset is sold and the note's retired. Now, this was bonus depreciation. So whatever you sell the asset for, that's taxable. So what do? Well, we rinse and repeat and can do the program again, or we use another strategy to eliminate the income that's created by it. This is designed to be repeatable and happen over and over. Now, there's a key here. First, personal guarantee. The second is material participation. So every year, you, and if you're married, combined with your spouse, have to have 100 hours. And that can be done by doing your due diligence. Inside the program, there are ways to participate. If this is something that's of interest, well, we can do a discovery call and talk a little bit about it. Now, direct oil and gas investments are a little bit easier. But, you know, I told you, you got a multiplier on LBOs. There's no multiplier here. Risk brings rewards. This is a level 2. So what we're doing is called a working interest investment, okay, which is automatically going to give you the material participation requirement fulfilled. We don't have to do that. So let's say that I put in 100 grand. I get to write off 80% of that 100 grand up front as intangible drilling costs. So that's an $80,000 write-off. The remainder I'm reclaiming over 20 years. Now, a good one of these will start cash flowing within 6 weeks, okay? And each year, that cash flow, I can offset my income with a depletion allowance. As the resource shrinks, we get a depletion write-off, okay? This is a level 2, very safe, very old school tax strategy, but it works. Now we've attacked above the line. Let's attack below the line. And these are just 4 of the tricks that I love. And I include the private foundation because this always comes up. So the first is a donor advised fund. It's a level 2 strategy. This basically acts as a bank account to where you could put $200,000 into this account, take the write-off this year, and then dole out your donations over the next 3+ years. Okay. State credit programs, level 1, no risk. Okay. Here in Georgia, there are 4 different programs. Many states have state credit programs, and I'll explain a little more about those in a minute. Tax equity with a donation option. This is basically an intangible asset donation, and these things can have a ratio for return 3 to 1 plus. I'll explain that in a few minutes. And then there's the good old private foundation that everybody seems to want to set up one day. This can be a level 2 risk all the way up to a level 4. It depends on what you're doing. So, something to realize, charitable deductions are limited. So we're going to attack first. We are going after above the line, reducing your adjusted gross income. Now we're going to come in here and we're going to attack on Schedule A and down below with credits. So charitable vehicles, credits. All right, and the sequence matters. And guess what, guys? If you're a high incomer that usually can't itemize, some of these charitable programs will allow you to itemize, and you're able to pick up a lot more deductions, like between $25,000 that you haven't been able to take in the past because you're stuck with a standard deduction. So here we go. Donor advised fund, very flexible. What we're doing is we're donating to the donor advised fund, and most of these can be set up with your financial advisory house. They're that simple. The funds inside still continue to compound, but it's totally tax-free. And now you tell the donor advised fund each year, send X amount to First Baptist Church, send X amount to March of Dimes. Whatever your favorite charity is, you direct where the money goes. But here's the thing, you get the write-off in the year that you put the money into the donor advised fund, not necessarily in the year that you make the donation. I love the state credit programs. My favorite in Georgia is the Georgia Heart, even though there are 4 programs. Now, most of these programs work the same way and state to state. So let me just give you a rundown. I like the Georgia Heart because after June 30th, I have an unlimited ability to donate to the Georgia Heart. And what I do is I take whatever my state tax liability is, and that becomes my donation to the Georgia Heart. I am going to get a dollar for dollar state tax credit. So that money that I put in Georgia Heart, if I'm W-2 and have withholdings, I'm going to get all my withholdings back. So I'm moving money around. But now here's where it really pays off and makes sense. That money that I donated to the Georgia Heart is also going to be a federal contribution on my Schedule A. So it's not really double dipping because it's a credit on the state. I take the deduction on the federal, but I have to add it back on the state. But this is a no-brainer. I'm paying off my tax by donating to a charity, and I get to claim it as a write-off. Yesterday, one of the plans I was putting together literally saved the client just by this move $10,000 additional dollars. Not bad. Tax equity with donation option. This is a powerful tool. It is a level 3 strategy. Okay. What we are doing, this is a program. I am acquiring these intangible assets, which are usually software licenses, or I can get a medical equipment portfolio. There are several different programs. Okay. I'm acquiring them at a deep discount. Okay. Now, I can turn around and transfer them to a 501c3. Okay. There's my donation. And the beautiful thing, even though I got a deep discount in step 1, I get to donate at fair market value. And we have an appraisal. It's a desktop appraisal. It's done after the donation. And it's based on the fair market value, not somebody's opinion. We claim the fair market value deduction, and typically we're going to see 3 to 1 or greater, depending on the program. Now, right now, this is low IRS scrutiny. You properly structure it with an approved recipient. Transactions are defensible. They carry a should opinion from qualified tax counsel. So they are a very nice trick. And of course, I am simplifying this for you. Okay. There's more to it than this, but the substance is right here. And last, of course, is the Private Family Foundation. Now, this is a powerful tool for high net worth people, but you better be prepared to work. Okay. The reason I said it's a risk level 2 to risk level 4 is it's so easy to drop the ball inside of this. Now, your donor controls everything. All the money is controlled in here. The contributions have an immediate tax deductibility up to 30% of your adjusted gross income. And you control where the money goes. And yes, you can even pay salaries out of this, and you could have deferred compensation depending on how it's set up. But compliance and complexity. There are strict IRS rules. There are strict reporting requirements, self-dealing issues, annual distribution requirements. This is not, let's just design something on paper and go with it. This can be a full-time job. Okay? Actually, this can be several full-time jobs. I don't always recommend it, but for some people, it fits. So what I wanted to do now is just show you some results that we've actually achieved. First, let's talk about a mini deferred sales trust. You know, Bob here didn't have $1 million, okay? But he's doing liquidations that are going to come close to $1 million over a series of years. So for 2025, we did a mini deferred sales trust. And this resulted in spreading tax over 20 years. And because those tax savings, he's going to be in a much lower tax bracket over the years instead of the one-time liability of $156,688. We took tax savings and spread them. Now, the investment requirement was $45,000 because now you don't think that it doesn't cost something to set these things up, okay? But there is a deductible part of that. So Bob has eliminated over 90% of his tax liability for 25. Okay. How about Michael and Sarah? They had a big capital gain because they sold their business for $1 million. And when all was said and done, they had $238,000 worth of tax liability out there. We were able to eliminate, using a leveraged business opportunity, $238,000, the full liability. Now, the investment was $160,000, but that produced a positive cash flow of 78 grand. We have redirected money that would have gone to the IRS to the strategy. Okay, so we paid for the strategy with what we would have paid to the IRS. They pay zero in federal taxes. They pocket 78 grand right now, and they have a monthly cash flow, and they're going to have a liquidity event on the back end and an overall ROI. Let's talk about Dr. K. We also used leverage business opportunity. Dr. K is making a lot of money, 2.3 mil. And at this income level, you know, that federal liability, that's staggering, $777,000. Ouch. He did $1 million into the LBO, and that saved him $379,000 in federal taxes. Okay. Same investment, $160,000. Well, Roger, why did he have higher savings than the last one if it was both $1 million? Ah, Bob was capital gain. This is ordinary income. So the good doctor had to put up $160K, but look at his cash flow. $219,000 that would have gone to the IRS back in his pocket. The $160K investment would have gone to the IRS. Instead, it's producing a monthly cash flow and has an ROI on the back end. Then there's Michael. Michael's a younger fella. He wanted to convert some Roth. Michael works in the tech industry and he makes about 800 grand a year. Yeah. Now his 401k also has 800,000, but it's in traditional. The problem with traditional is one day you have to pay tax. So the strategy was a tax equity donation paired with Roth conversions over 10 years. The objective was to convert everything to Roth. So here's the results. Here's what happens. We do the tax equity every year. We've done enough in tax equity to where we redirect money that would have gone to the IRS to pay for the tax equity strategy, and we eliminate one-to-one the income created from the conversion. So when Michael retires down the road, he's going to have an additional $1.2 million in his Roth account than if he was paying tax at the end. Because now all of his compounding is totally tax-free. Pretty cool, huh? So here's some frequently asked questions, guys. How much income do you need to qualify? Well, you know what? I can work with $350,000 depending on the circumstances. Some of the easier strategies will work just fine. But it's like I tell people all the time, it's easier to eliminate $1 million in income than it is to eliminate $100,000 in income. Okay? Why is that? Because at $100,000, you don't have access to the type of strategies we're talking about. What's the minimum investment? Well, it depends. The LBO programs start between 40 and 100 grand, but oil and gas and donor advised funds could be as little as $25,000. So we look at your financial profile and we match strategy. Do I have to be an accredited investor? Well, I would prefer that you are, because some strategies, particularly the tax equity and oil and gas, those are SEC Regulation D offerings. So they require accredited investor status. Some don't, but I would much rather you be. So what is an accredited investor? An individual that has a net worth over $1 million, excluding your primary residence. Okay, your residence is not liquid. Or you have an annual income. If you're single, 200,000. If you're married, 300,000. You have to have had it for the past 2 years with the expectation that it will continue. What's the risk? You tell me. All strategies we recommend are defensible. They have been used. None of this is what we call beta testing. We work with properly structured and vetted programs. Now, we review risk with all the clients, and in fact, we require our clients to sign that we have explained the risks that they are undertaking. Okay? Will this hurt my ability to borrow money? Probably not, because a lot of the programs are either Schedule A, which doesn't affect borrowing ability, or they're depreciation based. Depreciation does not affect borrowing ability. Now, deferral programs, different story. That could hurt if we put away too much. Okay? So how do you get started? Call us. No obligation, free discovery call. Okay? From that discovery call, you move to the next level. We will create a custom tax reduction plan. And you know what? Planning is an every year kind of thing. I've had one-off clients. I just got a problem this year. But the clients that save the most, we're working with every single year. So, how do you schedule your free discovery call? Go to theinvestorsaccountant.com and in the upper right-hand corner, click the button. It's been great being with you guys today. I want to thank you for joining us, and there will be other parts of this series coming out very, very soon. I hope to talk with you in the very near future. Until then, Roger out.